Hello and welcome. In this explainer, we're diving deep into a really crucial provision of the new Income Tax Act 2025. We're talking about Section 87. Now, this is a potential game changer for any industrial business that's even thinking about relocating. So whether you're a business owner, a tax professional, or a chartered accountant, you're gonna want to pay close attention. Let's get right into it.
So, just imagine this for a second. Your manufacturing business is doing really well, but it's kind of stuck in a cramped, congested city center. You know you need to move to a bigger, more modern facility somewhere outside the city to really grow. But here's the problem, right? Selling your current property, that could trigger a massive capital gains tax bill. So big, in fact, that it could make the whole move completely unaffordable. And believe me, this is a very common dilemma. But what if there was a way around that giant tax bill? Well, the government has actually created an incentive for exactly this kind of situation. The solution is baked right into our new tax code in Section 87, and it's specifically designed to make industrial relocation a smart, tax-efficient move. So let's really unpack this section, shall we? What's its main purpose? And more importantly, who can actually benefit from it? Understanding the why behind the law is always the first step to applying it correctly. The thinking behind this policy is actually twofold. First, it's about decongesting our crowded cities, which helps reduce things like industrial pollution and the strain on public infrastructure. And second, it's about promoting more balanced regional growth by giving industries a real reason to set up shop in less developed, non-urban areas. It's really a strategic move for the country, and it's all driven by this tax benefit. Okay, so the very first condition is about eligibility. Who gets to claim this? Well, this exemption is specifically for an industrial undertaking. And the definition, which you can find in Section 127B of the Act, is actually quite broad. It covers everything from manufacturing and software development all the way to power generation and mining. If your business is in one of these categories, well, you're on the right track. The second critical piece of the puzzle is the term urban area. For Section 87 to even apply, the property you're selling, your original factory, has to be located in an area that the central government has officially declared as urban. This isn't just a general term. It's a specific designation you absolutely have to verify before you go any further. Okay, so let's say you've confirmed you're an eligible industrial undertaking and your factory is in an official urban area. Fantastic. Now let's get into the mechanics. How do you actually go about securing this exemption? The whole process really breaks down into 4 clear steps. First, you sell your original asset in the urban area. Second, and this is the most important part, you use that money to reinvest in new, qualifying assets in a non-urban area. Third, if you haven't managed to use all the funds by the time you file your tax return, you have to deposit the rest into a special account. And finally, you make the claim in your return. See, it's a structured path, but it's pretty straightforward. Now, the timeline for this reinvestment is actually quite flexible, which is great because it shows the law understands real-world business. You basically have a 4-year window to work with. You can start buying new assets up to 1 year before you sell the old one, and you have 3 full years after the sale to finish your reinvestment. This generous timeframe really helps because we all know that major industrial projects take time. So, what can you actually spend the money on? The law's pretty specific here. Your reinvestment has to be in qualifying new assets. This includes things like new machinery and plants, buying land or buildings for your new business location, constructing a new facility from scratch, and even covering the direct costs of shifting your old equipment to the new place. Let's talk numbers. How is this exemption calculated? As you can see, it's actually quite simple. If the cost of your new assets is equal to or more than your capital gain, then fantastic. The entire gain is tax-free. If you invest a little less, then the difference becomes taxable. But pay very close attention to that last row. This is the critical catch. If you turn around and sell that new asset within 3 years, the exemption gets taken back. That is a vital point to remember. All right, theory is one thing, but let's make this real. We're going to walk through a quick case study to see exactly how Section 87 plays out in practice. So let's introduce our hypothetical company, Apex Industries. They are the perfect candidate for this provision, a successful manufacturing unit, but they're constrained by their city location and are ready to move to a non-urban area so they can scale up. So Apex Industries goes ahead and sells its old factory and the land. After all the calculations, they've made a long-term capital gain of 5 crore rupees. Now, without Section 87, this entire amount would be taxable.
Over the next couple of years, they invest a total of 6 crore rupees in a brand new state-of-the-art facility in a designated non-urban area. This includes everything: the land, the building, new machinery, the works.
So let's just compare the two key numbers here. The cost of their new assets, 6 crores, is clearly greater than the capital gain of 5 crores. This means they have met the main condition for a full exemption. And the result? It's a huge win for Apex Industries. That entire 5-core capital gain is now exempt from income tax. This is a massive direct saving that makes their whole expansion financially possible, and it just perfectly illustrates the power of this provision.
But wait, there's a really important compliance step. Let's say in our example, Apex had only spent 2 crores by their tax filing deadline. What then? Well, to keep their claim alive, they must deposit the unspent portion of the capital gain, that's the remaining 3 crores, into what's called the capital gains account scheme. This is a crucial step. It tells the tax department, hey, we fully intend to reinvest this money, and it keeps their exemption claim valid while they finish their project within that 3-year window.
Now, as you can imagine, claiming this kind of benefit requires real attention to detail. So let's talk about compliance and some of the common mistakes that can completely sink an otherwise perfect claim.
First off, for all the seasoned professionals watching, you might be thinking, this sounds awfully familiar, and you'd be right. Section 87 is the direct successor to Section 54G of the old 1961 Act. The good news is, the core principles, the timelines, the mechanics, they've all been carried over. This ensures a nice, smooth transition, and it means all the old case laws and understandings are still very much relevant.
So here are the biggest pitfalls you need to avoid. First, misinterpreting that official government notification that defines an urban area. That's a classic mistake. Another one is simply missing the 3-year deadline for reinvestment. Forgetting to use the capital gains account scheme is a procedural error, but it's a very costly one. And as we've already stressed, the biggest mistake of all is selling that new asset within the 3-year lock-in period. That will trigger a complete reversal of your tax benefit.
And let's just hammer this point home. What happens if you violate that 3-year lock-in period? The law is crystal clear. If you transfer that new asset too soon, the exemption you claimed gets reversed, and it becomes taxable income in the year you made that transfer. It's a serious consequence, and you need to be aware of it.
All right, we have covered a lot of ground today. So let's just boil it all down into a few key takeaways to make sure everything is crystal clear.
So here's your final checklist. First, remember the purpose. It's tax relief to encourage industrial relocation. Second, check your eligibility. Are you a qualifying industrial undertaking? Third, keep that flexible 4-year timeline in mind for all your planning. Fourth, aim for that full exemption by making sure your reinvestment is equal to or more than your capital gain. And finally, and most critically, respect that 3-year lock-in period on your new asset to protect your tax benefit. At the end of the day, Section 87 is a really powerful tool for business growth, but it absolutely demands careful planning and strict compliance. Thank you for watching. Please like, subscribe, and share. This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.